What is up, everyone? Joseph Hadaway here, once again to help you get your money and your finances on track. For anyone here who knows me, you know that I preach index funds, and I most often preach the S&P 500. Simple reason why I firmly believe that investing in index funds is the best way for absolutely anyone to become wealthy. And I believe the S&P 500 is one of the best indexes out there for you to invest in. That's not an uncommon opinion. You'll hear basically every other financial talking head say the same thing. But for the sake of today's video, let's just say, what if the S&P 500 had a 0% return? How long would that take you to notice, or how long would that take you to be a concern in your portfolio? I mean, of course, a day of no return, all right, it's kind of whatever, who cares? A month, it's getting a little weird, but not unheard of. A year? I mean, we've seen negative years in the past. We've seen the S&P 500 crash, so, a year of 0% return, it sucks, but it's really not too bad. Okay, but what if there was a decade, like an entire 10-year stretch, where the S&P 500 had a net zero return, or very close to it? That means no investment growth whatsoever in terms of capital gains or share prices. Would that be concerning? What would that do to your portfolio? How would you navigate a market like that? Lucky for us, we can look back at when something like this has happened in history before. And that's why in today's video, we're going to be talking about the lost decade. All right, so starting this video off, we're going to go back a little bit. All the way back to 1991. So back in 1991, the S&P 500 was coming off a moderate down year, and then all of a sudden it bounced back in full force, jumping up more than 26% in a single year, which is a pretty significant return. Next 2 years are pretty modest, seeing about a 4.5 and a 7% gain respectively, before another, very slight drop, only about 1.5% in 1994. So from there, the bull run was on. 1995 saw 34% growth, 96 saw 20.26%, 97 31%, 98 26.67%, and 19.5% growth in 1999 again. This bull run was insane and absolutely unheard of at the time, and really still ridiculous today. To give an idea of how amazing this was, if you invested $100 into the S&P 500 on January 1st, 1995, it'd be worth just a few cents short of $320 by December 1999. That's just a casual 200% simple return in less than 5 years, which is ridiculous. So what was causing this record-breaking bull run? Rising earnings and the heavy growth of internet companies, to sum it up. And really, at this point, to say the least, the future was looking bright for the U.S. economy and the market. But that all changed at the turn of the century. In 2000, the dot-com internet bubble popped, and we saw something we haven't seen since the 1940s, and it hadn't been seen again since. 3 consecutive years of negative S&P 500 returns. The index fell 10% in 2000, 13% in 2001, and a whopping 23% in 2002. To say the least, at this point, there was blood in the water. Using the same example as before, if you put $100 into the S&P 500 in January 2000, that same $100 would only be worth about $60 by the end of 2002, or a simple return of about negative 40%. Over the next 7 years, the market kept doing what it does, being basically a roller coaster. We saw a nice rebound in 2003, and the S&P 500 returning about 26.5%. Then a couple years of single-digit returns, a 10% here, a 12% there. Then 2008 happened. If you don't already know, 2008 was a devastating crash in the stock and the real estate market, where at the end of the year, the S&P 500 had fallen about 38.5%. We then saw a nice return to form with 23.5% and 13% returns in 2009 and 2010. So what's the point of going through all of this history lesson together, 20 years of just straight S&P 500 returns? Well, as I mentioned earlier, 2000-2010 is referred to as the lost decade. During this stretch, the S&P 500 had a real return of about 0.95%, assuming you reinvested all your dividends, or negative 2.72% if you didn't. That means if you put $100 into the S&P 500 on January 1st, 2000, and you reinvested all your dividends, it'd only be worth about $99 by January 2011. And that doesn't even account for inflation. That's basically 10 years of capital gains growth just down the drain. And, for most of us, that's about 25% of your working life. Can you really afford to miss out on all of that money? Well, that's only partially true. I've talked before in a lot of my videos, and I'm going to keep talking about it, how timing the market is basically impossible. And if anyone says they can regularly time the market, like, day traders, they're lying to you. That's why I preach dollar cost averaging, or DCA as you probably see it online. Simply put, dollar cost averaging is investing smaller amounts of money into the stock market, into like 1 or 2 good index ETFs over a long period of time, rather than say investing a lump sum all at once. A great example is your 401k. I mean, you put $100 into there every 2 weeks as an example, and it goes into the same few mutual funds. In short, dollar cost averaging helps you take advantage of the regular volatility in the stock market, and it does a lot also to take the emotions out of investing. If you're just investing $100 every week, you don't really need to watch your portfolio too much. So if you invested a lump sum of money into the S&P 500 on January 1st, 2000, by January 1st, 2011, you would have in total lost 2.7% of your money. But what if you dollar cost average over that whole decade? Would it be any different? Would you make money? Would you lose more money? Let's take a look at that. All right, so what I've done here is create a spreadsheet of the S&P 500 returns from January 2000 all the way through January 2011. And at this point, I should really just start writing this at the beginning of every video, put it on my channel banner, everything. For this example, I'm using the SPDR S&P 500 ETF and Trust, or SPY. This is not investment advice. It's not a recommendation. It makes this portfolio, it makes this example very easy to demonstrate. And also Vanguard's VOO didn't come around until 2010, so picking a S&P 500 ETF for this, my options were a little limited. And before anyone says it down in the comments, I know index ETFs aren't an exact track of the S&P 500, but they're the closest thing we got right now and makes this really easy to demonstrate. Moving on to the spreadsheet. All right, so everything on the spreadsheet is dollar cost averaging. It's as if you invested $100 into SPY the first trading day of every single month from January 1st, 2000, all the way down to January 1st, 2011. As you can see here, I got the open price, the close price, and how many shares you purchased for your $100. This number here is based off the closing price. And looking at some of these prices, man, I would love to buy SPY at some of these prices. Let's just real quick see why. Yeah, $379.12 versus $107.22. I like 107 a lot better. Either way, back to the point here. Let's look at some statistics. So if you, like I said, invested $100 into SPY on the first trading day of every single month for this decade, you would bought a total of about 157.5 shares of SPY. That is a total investment of $13,300 on your part, and the market value of these investments as of 1/1/2011 would have been about $20,200. Not bad right there. I mean, that's a simple return by itself of 52% over the course of a decade, and that beats our benchmark here of negative 2.72%. So point for dollar cost averaging already. And to break this down a little more, they call this the lost decade, as if you got a 0% return, which again is true if you just bought on January 2000 and held until December 2010. But if you kept dollar cost averaging, you'd be averaging a return of 11.64% per year. That's a pretty good, pretty standard S&P 500 return, and especially over the course of a decade, you did very, very well for it. I mean, so here, we have it just straight up mathematically. If you'd like a copy of the spreadsheet, I'll put it down in the comments. You can check my numbers on this. Dollar cost averaging is the best investing strategy. So what's the point of this video, you're probably asking? Did I really go through, write, record, and edit a video just to talk about S&P 500 returns in a random 20-year stretch? No, not exactly. Everything's got a point, I promise. The point of this video is to tell you to tune out the noise and demonstrate how dollar cost averaging over a long period of time is the best way to invest. I've said this before, my whole point of this channel and all of my content I make on Twitter, Instagram, my blog, is to help you handle your money better, invest better, and build wealth. I win when you win. Also, we're seeing some parallels. Markets are down right now. At the time of recording, S&P 500 is down a little more than 20% year to date. I can't tell you how long this downturn will last. We might be green by next month. We might not be green again for 5 years. No one else can tell you either. So the best thing you can do is write out this volatility and keep to your investing plan and the course you have in front of you. It doesn't have to be the S&P 500, but as long as you know you're buying good quality companies and good quality index funds, those who keep investing and stick to their investing plan during these downturns will come out ahead and they will be rewarded for it. All because it's down. Again, if you believe in the long-term conviction, there's no need to panic sell. Just stick to your plan, and in a few years, you'll be really, really glad that you did. All right, so was it really a lost decade? For a lump sum investor, yeah, it was. But for your dollar cost averaging investor, that was a pretty good 10-year stretch. Of course, if you timed the bottom of the market, your return would have been higher, but I'm gonna keep saying this timing the market is not a practical long-term investing strategy. You might get lucky once or twice, but it's not something anyone can do reliably. So dollar cost averaging will always continue to be your best strategy to ride out volatility and make money investing long term. If you like this video and you want to see more personal finance and investing content, make sure you drop a like on the video and subscribe. I really appreciate it. They both help me out a lot. Make sure to follow me on Instagram and Twitter, and check out my podcast over at Work Hard, Retire Early. I'll link all that in the description below. And thank you all so much for watching, and I'll see you next week.